after this session. So welcome, Kimberly.
Great, thanks. Thank you, Michelle, for that warm introduction. And it's a pleasure to see some of you again and to meet many of you for the first time. I'm very excited to speak about the Conservancy. And typically I go a little, I do a little background, but Michelle, I think you covered it with my intro, but I'll just say that, you know, I have worn many hats over my career. And so I've sat in many of the places that you all sit in terms of working for local government, which I did for the city, DC, Washington, DC for several years, over about 13, and the city of Detroit, as well as working for-profit, did some for-profit consulting earlier on in my career, and have been in the not-for-profit space as well. This is not my first time working for a not-for-profit organization. In fact, my first job out of graduate school was working for Enterprise in Columbia back in the mid 90s. So it was Enterprise Foundation back then. So I say all that to say is that very experienced in affordable housing and urban development in the region. I've had a focus on DC for most of my career, but really excited about what the Washington Housing Conservancy is doing because it is regional, and we do intend to work in all the surrounding jurisdictions in DC. So with that, I'm going to share my screen. Okay. All right. First challenge is met. Okay. Success. Okay. So I have a presentation that's going to probably take about 10 to 15 minutes and then have a conversation. I know there's probably lots of questions given the announcement of our first acquisition last week. And I know some of you might have seen some of these slides, so forgive me if some of you have seen this, but I think for a majority of you, a lot of this information will be new. So as Michelle mentioned about the Conservancy, we were established in 2018, and our mission is to preserve affordable housing, prevent displacement, and promote economic mobility, particularly for moderate to low income people of color. And we are an independent, not-for-profit 501c3, and we really think about housing preservation. We are looking at preserving existing affordable housing, what's affordable today, but could quickly be lost to the market. And I know that this is a phenomenon that's happening in Northern Virginia. It's happening all over the region, but in Northern Virginia in particular. We're competing with for-profit developers, and we're working in high opportunity neighborhoods. And I'll define what I mean by high opportunity neighborhoods in a few slides. But essentially, we are looking at the naturally occurring affordable housing. So this is what is currently affordable today, but this product is market rate affordable. So it's unsubsidized is the space that we are in. So we're very specific in our intervention. And we are thinking about housing stability, and not just about the preservation of rent, but also thinking about how residents can thrive in place. And I'll go through our theory of change in the next slide or two, but these are sort of the four things that you should really know about us, is that we really are, I believe, disrupting market forces that really make affordable housing difficult, particularly in the unsubsidized space. Our guiding principles, we have 5, and they're all equally important. I'm going to spend some time on a few of them. Some of them are pretty self-explanatory, but a few that are worth talking about. First and foremost, we're about advancing racial equity and inclusion. And this is something that we've talked about and thinking about not just the events of last year, but really, what has happened historically in the housing, with housing policy in the US that's created a lot of the inequity that all of us, I think, are working to eliminate. So, we're thinking first and foremost how we can dismantle, systemic racism within the housing space. And where we're working, I think, speaks to that because traditionally, in a lot of the high opportunity neighborhoods, people of color have had a lack of access to those neighborhoods for a variety of reasons. We're also strive for universal quality. By that, I mean, these are buildings that any one of us would want to live. We are in the mixed income space. Our properties will always have a mix of residents living in them, from low income to market rate. Our focus is on the moderate or middle income, but we have the complete spectrum of residents and incomes living in our properties. And so the design, it's intentional that we are looking at quality across the board and throughout the building, not just for market rate. We are maximizing resident choice and voice. This is really speaking to our social impact strategy and how we will be operating the building. We'll be partnering with world-class service providers, but on the actual, within the properties themselves, really uplifting residents' voices through a co-creation model. Residents will be weighing in. We will be interacting with them through direct interviews, just human interaction, to really understand what their values and struggles and issues are, to help design a social impact strategy that really is impactful and tailored for the residents in our properties. And the last two, really thinking about just our need to be innovative and agile and promoting respect and trust in our environments. So I mentioned that we're not just a housing play, and we are thinking about how residents thrive in place. And this is really our theory of change, thinking about how we promote residents' well-being. And I could spend the entire time on this slide. I love the components, but I am going to kind of go through this fairly quickly. And those who are interested in more of a deeper conversation can certainly follow up. But we are really thinking about housing stability and service of something deeper, which is economic mobility and how residents thrive in place. We are, as I've talked about, working in high opportunity neighborhoods, and we'll be defining that in the next slide, and thinking about mixed income housing. So this is sort of the universe in which we're working in. Our strategies around social impact really revolve around four key things: inclusive property management, human capacity and wealth building, placemaking, and community building. So the next slide really talks about what we mean by these four key strategies. And these four key strategies, really each of our properties will have these four key strategies. Which ones we move or advance will really be driven by the residents and how they voice what's most important to them. But just to give you a sense of what I mean by all four, with placemaking, that's really thinking about the asset itself and where the building sits within the community, and fostering a deeper sense of place with respect to the built environment. So what are the shared common spaces? A lot of the buildings that we're thinking about acquiring don't have those common spaces that you see in the more current building stock. What are things that we can do that can foster a deeper sense of place and cultural preservation and well-being? That, coupled with the community building, which I think most of you are familiar with, we think are really, it's a powerful 1-2 punch. And community building, promoting the connections among residents, building trust, a sense of social cohesion and belonging and mutual well-being. and what are the things that we can do to enable that, to invite residents to be more vested in their sense of place with respect to where they live. Inclusive property management, this is really critical in mixed income communities and mixed income buildings. This is really the intentional prioritization around thinking about how mixed income residents are being attended to. We know that sometimes in mixed income properties, there's an othering that can take place. Just because you're living with diverse people of all backgrounds and incomes doesn't necessarily mean that you're interacting with one another. It doesn't necessarily mean that all voices are being heard. And this is from research from the national intermediaries such as LISC and Enterprise and the National Initiative for Mixed Income Communities, which is the organization that we're working with. There's a body of research that suggests that inclusive property management is really one of the keys, the linchpins to creating successful mixed income environments and communities. And so it's really, we'll be doing some training with our property management staff. We'll be thinking about resident experience coordinators or resident life coordinators that will be on the ground helping residents thinking through their needs. And this supports our social impact strategy. We will have resources on the ground in our first building that really will support all four of these strategies. And the human capacity and wealth building, that's really thinking about what are the services, supports, and experiences that really promote economic mobility. And I think that for a lot of people, this is not just for low-income folks. We know that folks are very much rent burdened, and we know that wealth building can be challenging, at all income levels. So what are the tools, whether it's educational advancement, whether it's thinking about daycare, whether it's thinking about financial literacy? We know that a number of residents still desire home ownership. What are those supports that can enable human capacity and wealth building, and that will lead to greater self-determination? These are going to be things that residents will tell us through surveys and focus groups. We're not coming in top down saying this is the program. We are inviting residents to co-design and co-create based in these categories. And there might be some things that we haven't even identified yet that will emerge through our engagement with the residents. So this at a high level is our social impact strategy and our theory of change. It's very ambitious. We think that we're going to be able to achieve it over time, and we're looking at resources to invest outside of property management to make sure that we're able to implement this strategy. So I've talked about high opportunity neighborhoods. Here's how we're defining them. This, I know for a lot of you that are housers are used to Raj Chetty's definition. Raj Chetty, the famed Harvard economist, that really, his life work has really been focused on economic mobility. But we're defining it a bit differently. We're looking at areas with above average population growth. That is a key for us. It's a key driver for our model. It's a key driver for the selection of the apartment buildings that we will eventually be buying. So this map on the left, you'll see the blue blobs really represent the high opportunity areas. It's above average population growth. It's proximity to jobs and transportation. You'll see that we're along the purple line. We're also along the metro corridors and high quality bus. These are areas that have large rental housing stock. Some of that stock is at risk of being lost to the private sector. And they're already mixed income areas. So they're already places where you have a mix of people, diverse set of people living there. So we don't have to, when we buy our buildings, we don't have to reconfigure the mix. Most of the properties will already have a mixed income population living in them. And this is just some stats around the impact. We do know that zip codes drive outcomes. That research has been clear for decades. And so, where you live can really determine your life outcomes to a large degree. So really thinking about how we promote access and opportunity in these high opportunity areas is really front and center for us. The structure of the Conservancy and the Washington Housing Initiative, we are part of a larger ecosystem, the Washington Housing Initiative. And I know it's confusing for some people about how all the pieces relate. So this slide is meant to help explain our three components, our three main components. So the Washington Housing Conservancy is what I direct, executive director, and we're the owners and operators of the real estate. And we're also the implementers of the social impact strategy for the initiative. We have fundraising goals, and I'll talk about that. We have a $30 million fundraising goal for self-sufficiency. It is envisioned that once we have a core set of properties, that we will be able to be self-sufficient and not always in fundraising mode, that the revenue from some of the market rate rents will go to sustain some of the operations, but also, our money goes to acquisition, it goes to social impact implementation, and it will go to overhead. And so we're estimating that $30 million is what we need to capitalize us sufficiently. The impact pool is something that some of you have invested in, and this is run by our partner, JBG Smith, and it offers a 7% capped return to investors. And currently they've raised over 112 million to date, and their fundraising goal is 150 million. This is really critical because they provide the mezzanine financing for our projects. And so again, we're not looking at traditional housing finance tools here. We will never use LIHTC. We don't use any of HUD funds. We don't use any of the traditional housing affordability tools to do our deals and our acquisitions. And the Stakeholder Council. The Stakeholder Council is something that we will be initiating and establishing first quarter of this year. And it's really meant to think about advocacy and policy. In this space, most of the work has been in the areas that I talked about around low-income housing tax credits, around the most in need, around supportive housing. There is some thinking around what's being done in this unsubsidized space, but I think there's room for more, and thinking about how do we preserve this housing stock that is, quite frankly, the stock that's evaporating at the highest rate, at alarmingly high rates. So what are some of the tools and mechanisms that have yet to be created by legislators, by policymakers, that will help preserve the stock? That's what the Stakeholder Council will be focused on. So Crystal House, as many of you know, the Conservancy acquired its first property. We closed on New Year's Eve, so I was really busy over the holidays. I had no break, but super excited, working hard to make this happen. And it was announced publicly last week, and they'll talk about the deal. These are statistics that you all are much better familiar with than me. In fact, maybe some of you even generated some of this research, but you all understand the problem and the challenge probably better than most jurisdictions. I found your study, Missing Middle Housing Study, that was released last year, quite helpful. And a lot of these stats were pulled from that report that was created. But this slide is really just to really speak to the need in the space that we're working in. And again, I'm not going to go through these numbers because I'm sure you're pretty familiar with them. But Arlington, to be our first acquisition, is really significant for us. And the deal is a bit of a unicorn project, actually, for the Conservancy. Through our partnership with Amazon, we were able to buy what's currently, while it's mixed income, it's a market rate building. So this is the unsubsidized, naturally occurring affordable housing space. We were able to buy Crystal House, and we're going to be preserving affordability in perpetuity. We have a 99-year affordability covenant, which is pretty unheard of. We're going to be preserving, out of the 825 existing market rate units, which are in the 2 high-rise buildings, we're going to be preserving 619 of those units. So that's 75% will be dedicated affordable housing for 99 years for those making $85,000 or less. 20% of those units are going to be for those earning 50% or less of AMI. So again, while our focus is on middle income, we do have a distribution, and about 25% will be market rate, will remain market rate units. This was definitely enabled. We would not be able to do this project without Amazon. Amazon came in in this instance as the senior mortgage. So they were really, they provided our first mortgage. And you can see the distribution here. The senior mortgage represents 96.5%, 97% of the loan. 2% is the impact pool money, and 1.5% is the equity that the Conservancy put in. In this, because these numbers are so big, that 1.5% is small, but it was $5 million that the Conservancy put in. So it's not insignificant for us, that cost. This is very atypical. Our typical financing structure, the dark blue would be about 70% first mortgage. The impact pool loan is about 20%. And then the equity that the Conservancy puts in is up to 10%. So you can see that we were, because of the financing, because of Amazon's loan, and because it was well below market, the interest rate on that loan, it enabled us to do something pretty extraordinary in this case. In this case, the not-for-profit equity, we're leveraging a 60-to-1. That's remarkable, with private capital from the senior lender in the impact pool. In addition to the financing to acquire the property. We also received money for the land, and there's going to be 717 units of approved additional development. That is not development that WHC is going to do. We will facilitate, the transfer to the county and facilitate the development, but we will not be the developers of that additional. We will not be the developers of that vacant parcel, just to be clear. In addition, the Conservancy, I think that Amazon was most interested in doing something impactful and doing something that really was looking at the long game. And so when we were talking with them, I think we'd been talking with them for a while about a potential project, but the social impact work, as we developed it last year, that started to take center stage, and they provided a grant, a $2 million grant to the Conservancy to make sure that we are well resourced around social impact implementation, and really thinking about how, when we're transitioning to affordability, that we're also promoting economic mobility. And I think we all know that in a lot of traditional housing, affordable housing projects, it's one or the other. You have the housing, but you are limited because of the financing terms and the constraints of that funding. Families can't necessarily build their capacity, their financial wealth. So it's called the housing cliff. And again, most of you are familiar with that. And that's not the case here. We're able to do both, and we're able to do both, hopefully, in perpetuity. In addition to transitioning this to affordable, we are going to be making a series of investments in the building. So we're not sacrificing the building's overall experience and the quality. We're going to be making over $15 million in capital investments the first couple of years. So this really is an extraordinary deal for a lot of reasons. This slide, which is my last slide, really talks about some of the unique aspects. In addition to the financing, which I know a lot of you are interested in, it's the speed of the transaction. We were able to do this deal in less than 2 months. That is, when I tell you I had no break and no vacation, I really didn't. I mean, it was a lot. All of these are complex transactions, and we were able to move so quickly. Many of the Arlington County officials knew about some of the work that we're doing or trying to do, but we were able to do it, I think, just because of the tremendous will that we all had to get this project done. The preservation approach, really thinking about, it's a cost-effective way and tackling our region's affordable housing shortage. And I know that many of you are working in that space, and it's an and both, it's not an either or. You need new construction, you need new units for sure, but you also need to be preserving what you can. The conversion of the market rate units, again, I talked a lot about this in the slide before, but over a 5-year period, so we're not doing this all in 1 year. We've learned, I think research shows it's hard to make that type of a change so quickly. But over a 5-year period, we'll be lowering rents on 75% of the units so that they're affordable to middle to low income families. And our commitment is 99 years. And so with that, I believe that's it. This is really just this kind of a summary slide about the Conservancy around, I mean, I really do think that we're a unique fusion of capital, of using private capital and combining real estate expertise and social impact to really solve a challenge around housing affordability in the DC, Maryland, Virginia markets. So I believe we're really one of the entities that can be very impactful in the years to come around solving a challenge that all of you are dedicated to working on. So thank you so much for your time. I know there's probably some questions. I'm gonna stop sharing my screen and invite you all to ask away. Thank you.
Kimberly, thank you so much for the presentation. Certainly, since the announcement of HQ2, while there was a lot of excitement, the concern about preserving housing, especially in the neighborhood around the headquarters, was top of mind. And VHDA, who is now Virginia Housing, commissioned a study to look at preservation. And I think I may have shared that with you as well. What are the factors that put buildings at risk, and what are some of the strategies? So this, and certainly the announcement of the acquisition of Crystal House, which has been a property that folks in Arlington have been very concerned about, all of us have. So we are excited to hear that it will be preserved and that rents will eventually be lowered for people at low and moderate income levels. So I want to open it up to questions, and I think the best way to do this is just to go ahead and ask your question. I think that's the most spontaneous way. So whoever has a question, please go right ahead. Helen McElvain.
Thank you, Michelle, and Kimberly, congratulations on your first deal. That's very impressive. You know, one of the words you used was disrupting the market. And, you know, one of the things that I think we are all trying to understand better is how we can be very smart about the limited resources there are. I think even the announcement of Amazon making so much capital potentially available for below market loans, it's surprising how quickly one can spend $2 billion. I guess your strategy, which doesn't really call for leveraging that as much as one does with a tax credit type of financing structure, I wondered if you had something to say about that. And then the other thing is, how do we make sure, it's something we look for ways, how do we make sure we don't overpay for properties, even when our goals are to make them affordable? Because I think that becomes truly disruptive. you know, that we are, I know when we're working with nonprofits, we kind of get into a mode when they're, you know, multiples are looking at acquisitions, trying to kind of hold a line that says this much, but no more. Just because at the end of the day, they're typically, frankly, spending the city's money to, you know, and they're all coming in with an affordable plan. So, and then my last question, I'm sure others are interested, is what's the Conservancy's current capacity? I liked all your strategies. I just wondered how many folks are there in the in the office with you to work with residents, et cetera. So thank you.
Sure. Can you just remind me of the first question? And I'm hearing some feedback here. So I have the second two, like, how do you not overpay, or a question around?
Well, it was sort of talking about, you know, moving forward with essentially 3 sources of money, but not having part of your strategy being using any of the tax credit, you know, leveraging the resources that are available even further by using tax credits.
Right. So, well, you know, the tax credits are for something very specific. And, you know, we are, you know, I think that we're complementary to a lot of the affordable housing organizations that are out there. We don't see ourselves as competing because we're looking at different sources of funding, and that's deliberate. I mean, there is a need. Look, I worked for government for the city of Detroit and DC for many years, and I believe that government's mission should be focused on the most in need, and most of that financing goes toward the most in need, or producing housing for low income. And as you know, it's so hard. It requires so much subsidy to make those deals work. And so, you know, we were thinking about, you know, well, what else can we do that didn't drain those precious resources? So we're not looking at housing production trust funds for the areas and the municipalities that have that. We're not looking at low-income housing tax credits. We're not looking at HUD sections, because we know that money is in short supply, and it is for a lower band of AMI. And so, you know, we were really thinking about, well, what we know that middle income and workforce folks, that you know your hospitality workers, your teachers, you know, first responders are moving further and further away from where they work, from the core, because housing is expensive. And we're looking at, you know, the totality of the area, and like what makes our area great. And I think that, you know, we're at a real inflection point in the DMV. I think that, you know, we are, and it's interesting because when you talk to people from New York and California, they're like, oh, we didn't realize that DC was so expensive. But, you know, it's my personal belief that, you know, we're really looking at, you know, if we don't do some of the things that the Conservancy is trying to do, we're quickly going to become San Francisco. We're quickly going to become parts of New York, like Manhattan and even Boston, where the housing, you know, you're not having a lot of the middle income living in the city proper. So it's not so much about leveraging as it is about really thinking about the region and the vitality, and really making sure that we have all workers and residents living in and around the city's core, and making sure. I think this is a regional competitiveness issue. I mean, you know, not everybody, and I think that our model demonstrates that, you know, the private sector can step up. Like Amazon is Amazon, and, you know, they're a huge corporation. But if other corporations did what they were doing at a level, at a scale that was appropriate for them, you know, it would go a long way to like making a dent and solving our housing affordability issues in the region. So, you know, we're really trying to model, you know, a different way, and try to model behavior that we hope will catch on. We know that government can't solve this problem by itself. I've known that for years. That's what attracted me to this role, is that, you know, public-private partnerships are essential, and other sectors. And it's really interesting how the private sector, in many ways, you know, there's a disconnect with housing. You know, they don't necessarily get it around why they should care. And so, you know, I'm really hoping that this starts to accelerate a conversation that some of you have been having, that I've been having. In terms of overpaying, in terms of your question, like, the market is what the market is. It's hard. This is a market rate building. I mean, this is, again, a bit of a unicorn project for the Conservancy. We typically, this would have been way out of our price range, had it not been for a partner like Amazon to be able to provide the financing. And so, but in other projects that we've looked at in the district and Maryland, we're paying, our model, we're designed to compete with the private sector, and we have been successful. There's some things that have been pulled. Last year was a little bit of, was a wacky year for a lot of reasons, but in the real estate market, some of the projects that we were bidding on were pulled, and when there's turbulence, a lot of sellers decide to hold. It's just what they do. So, we were finding that we were competitive. There were definitely some things that, I think that were built to be competitive. So, we're going to pay, what the market is, and really think about that affordability over time. I think I answered most of your questions. I can't. You're on mute,
Kimberly, except for how many are there are.
Staffing.
And thank you very much.
So we're a lean organization, have a couple of folks on staff. We are going to be ramping up, as our portfolio ramps up. So we have, a staffing plan, but right now we're pretty lean, and we rely on consultants by design to keep our overhead low, but we will be growing in some key functions around social impact implementation, around some asset management functions as our real estate portfolio grows. We do share space with Federal City Council, so able to keep my office overhead low by sharing space with them. But the key areas of growth for us will be social impact, will be asset management, in terms of what I'll be looking to staff up for over the next 12 months.
Thank you. Other questions?
Yeah, Michelle, this is Eric.
Yeah, Eric.
Hi, Kimberly. My question is on the land side of your acquisition with Crystal House. Is acquiring land for spinning off to other developers part of the strategy?
Part of our strategy?
Yes.
Yeah, so that, again, this is a bit of a unicorn type of a project. We typically won't be buying land to spin off. That's not something that we'll probably be doing in the future. It just, was really around this site and what was needed and what was, quite frankly, been identified by the county and what has already been approved. So it was really specific to this particular acquisition around the land, but that's not something that the Conservancy will be actively looks for. We don't look for vacant land to facilitate development. That's not typically what we do. It's pretty unique to this project.
Hi, Kimberly. This is Melissa with Enterprise. Great to see you again, and thank you for the presentation. I wanted to follow up on two items that you answered for Helen and all of us. You talked about hoping that this can serve as a model for other private sector contributors, and I, very strongly agree that we cannot look to local government to be the only source of funding for innovation in housing affordability. Is there any existing or planned outreach to corporate peers, not only as contributors through the fundraising side of WHC's work, but also saying you could do this too, as part of that, not just hoping, but actually trying to kind of reach out and engage other private sector folks to participate?
Well, yes. The short answer is yes, Melissa. I mean, we've been engaging the private sector and corporations since my arrival and prior to my arrival. So, the impact pool we have been, but again, limited or varying degrees of success. I mean, I think that the eds and meds sector in particular, it resonates most with them because they have an inherent value proposition to have their workers close by hospitals, universities. So I think that there's some traction there, but also kind of looking at the Fortune 500 companies that are based in the region and really going out to them. As someone who's been on the job about 15 months, it's really just it's a question about pacing and growth. But certainly, there is an outreach strategy that is in development and in play, quite frankly, with some of the other corporations. And, I'm not saying that some corporations have contributed to the impact pool, have contributed through philanthropy. Marriott, for instance, the Marriott Foundation has contributed to the Conservancy. I believe they might be an investor in the impact pool. But there are others that we feel, could, and, we're getting some interest. I mean, we're a new organization and we were unproven. So I think, as we build a track record, as we build, our success, that will also accelerate the conversations that we're having and that we intend to have. And, Melissa, I know you through your work with the Purple Line Coalition, I think that's an area. I mean, looking at the corporations that are in and around the Purple Line, and I'd love to talk to you offline because we're actively looking around the Purple Line. I've actively been talking with George Leventhal, who heads it up at Kaiser around housing affordability. So there's already a built-in infrastructure around that, but I think that there should be some coordination maybe and some of the pitches, and I'm more than happy. I have no idea what the engagement has been like there, but I participate when I can in those larger discussions.
Yep, I'd love to take you out for virtual coffee where we could talk more about that, both for Purple Line and then also really even in Northern Virginia. We've got between the work of the Greater Washington Partnership, the organization that I'm involved with, or Coalition, and others on this call, the Housing Leaders Group of Greater Washington. I think that we might be able, working collectively, to really help bring more businesses into the fold. And I'm just gonna say businesses broadly, but thank you very much for the answer. Happy to follow up with you.
Great.
Jim Edmondson, do you want to raise your question that you put in the chat, or?
I didn't see the question in the chat. Does someone
Jim,
want to read it?
I think you're on mute, or maybe you're not. Maybe he's not logged on.
It looks like he's muted from the admin side.
So I will read his question. It's in the chat box.
Okay.
Jim says, I don't see your complementing work of the existing highly skilled and experienced nonprofits which do so much in Arlington. You are now potentially competing with them and others to buy NOAA properties, driving up prices. Is that helpful? It might be great in communities that lack capacity, but Northern Virginia is not one of those. So.
I have to say, I'm not sure, if we are directly competing. Again, I know some of the housing organizations, Wellesley, my board chair, David Rudberg, sits on that organization. And, my understanding is most of the work is geared toward lower income residents. I'm not aware, and you'll have to let me know, of which ones are in sort of the NOAA, which of the not-for-profits are looking at the NOAA properties. I'm sure there's some, but my overall understanding is most affordable housing not-for-profit organizations are in the sort of 50% or less AMI range. So I'd need to understand a little bit more which organizations are in the NOAA space that the Conservancy is in, and maybe we can work together on some projects. I mean, we have a model that's very flexible. And, we have looked at partnerships with other entities, not just like an Amazon relationship, but other housing organizations. We've had conversations. So, we by no means feel like, we're the only, the only game in town, and where it might make sense to partner. We're certainly open to having a conversation to see if there's a deal that we can do. So I don't know, Jim, if you want to talk to me offline, I'm happy to have a conversation with you.
Okay. Well, I'd like the chance to do that. I mean, obviously, you personally have some skills. You've got a fledgling organization, and you're basically, to my way of thinking, competitor at this point. I mean, I understand the goodwill. I think those of us who are involved in affordable housing of all types are probably wishing that we had access to the Amazon fund the way you do. But it's I would encourage you to be aware of the skill levels of those who you are now competing with.
Do any of our other nonprofit partners want to comment? Shelley Wesley was invoked.
Yeah, and I think I would say the same. Kimberly, I would love to have a virtual coffee with you, especially since we share David, who is wonderful. It's interesting. So all of the big parts of your strategy are exactly on point and not necessarily competitive, right? I think where we have the tendency to get concerned is because we are also trying to acquire properties that may be NOAA right now. And we, as nonprofits, struggle to figure out how to pay the prices that are out there. Hence Helen's discussion about how do you keep from overpaying. Yes, the market is the market, but oh my gosh, for us to be able to come together with the type of closing speed that you did and what is essentially an all cash offer and all of that, we're not able to do that. And yet when we preserve a property, we're going to preserve it at lower income levels, and our residents will see many of the advantages that you're trying to provide as part of your core mission. So I think that becomes the place where I sort of view my life as a series of Venn diagrams. So I'm going to say this is a bit like a Venn diagram where there's very many complementary spaces, and there is an overlapping space that it would be really nice to figure out on the front end. How do we negotiate that so that we are finding ways to work together to grow the pie, chasing after the same opportunities?
I agree. And I will just say, WHI, so the social impact pool, the investment pool, they don't have a mutual relationship with WHC. They provided, funding, mezzanine financing for the Parkstone, which is managed by the Arlington Housing Partnership. So that has happened. That was actually the first project that WHA, the Greater Initiative, did. So we understand the access to capital. We understand that. We understand. And so, the impact pool provides money, to those or for projects that need it. So, there's a couple different, conversations. There's conversation with the Conservancy partnering with us. There's also probably maybe you want to have AJ Jackson talk about the impact pool and, how that works. If there's the concern around access to capital, because that is the vehicle. So, we are solving for, what are some of the traditional barriers in the market, and access to capital is one of them. The impact pool, really is what was created to really help with that. Our traditional first mortgage is a Fannie Freddie, just like, you all's. I mean, that's what I'm saying. Like, this deal is so, it's our first deal, but, just to, I don't know how many deals like that we're going to have. I mean, it just happens to be, a pretty spectacular first project, but, our first mortgage is a Fannie Freddie typically. So anywho, I'm just gonna pause there, but AJ Jackson, Senior Vice President at JBG Smith, he's head of the impact pool, and many of you know him. I'm sure he's been in conversations with some of you.
He has, Kimberly. He actually presented to us when the impact pool first was announced, which I think was almost 2 or 3 years ago, back when we were meeting in person. John Frederick with Alexandria Housing Development Corporation, which was the Parkstone, is here with us. John, I don't know if you have anything you want to say, and if you don't, that's fine too. I didn't want to put you on the spot.
No, I think I think the point is the Conservancy is different than the impact pool, right? I think that's a point well taken. And I don't know. The more minds and money in this to try to solve these problems in Northern Virginia and the DMV area, I think the better. And hopefully we can all find ways to continue to work together and increase the size of the pot, not compete against each other, even though I know that's kind of the nature of the beast. So I don't know. I'll leave it at that.
Thank you, John. Are there any other, Nina?
Yeah, I just wanted to say, I really appreciated, Kimberly, that statement that you don't see using the LIHTC funds, the housing trust funds. And that I think is helpful for those of us who work in this space and feel the real dire need for people at 30, 40, and 50% AMI. So I think that's really helpful for me and sees that complementary line of not competing. I think our board and our organization, and I don't speak for other nonprofits, don't see the urgency in the 80% AMI, but your metaphor of, what if we become like San Francisco or New York in 10 years really does suggest that that's a different mission and a useful mission, maybe not as imminent, but also important for the long term. I think what's interesting for me is a lot of equity funds kind of came out and tried to rebrand themselves as affordable housing funds, and they were really just value add funds. They were going out there and trying to buy up this same NOAA housing stock and saying to investors, oh, and we're also going to be affordable for a minimum of 10 years. Well, 10 years is really a value add scenario, right? I mean, it's what the market does. You buy property, fix it up a little bit, and flip it in 10 years and make a lot of money off of it. So I'm really curious a little bit about, your 99-year commitment, because I think that's a very powerful change in that model. So you're saying we're going for the 80% AMI, but we're doing it for 99 years. Can you tell us a little bit about, the mechanism of that 99-year commitment? Who did you commit that to? And how does your financing dovetail with that? Because that is one challenge, I think, with the Washington Housing Impact Pool, that it has these 10-year balloons. So how are you going to get to that 99 years, and who did you make that commitment to?
So the commitment, before I answer that question, I just want to say that the Conservancy actually is a long-term owner, operator of the real estate. So this one is a unique one, but even in other projects, we plan on holding the properties. We don't plan on, our model is based on refinance, not reselling, not selling the property. So any additional projects that we have, we might not have a 99-year affordability covenant, but even if a covenant is 15, 20, 25 years, the goal is long-term ownership of the property in perpetuity. So I just want to be clear that actually is a mission of the Conservancy. And that is something that we look for in the profile of the properties that we look at is, our ability to own the asset in perpetuity. That is the goal. So, to your point, we are explicitly addressing that phenomenon around, it's like, can I get some type of workforce housing financing, whatever might be available, and then sell it in 10 years? That's not what we're interested in doing at all. So specifically, the 99 years really, and we're actually underwriting to LIHTC standards, even though this is private capital, we are underwriting to LIHTC standards on the deal. And part of it was really around, wanting to do something impactful. And, when you have a non-traditional financer, with Amazon, it was a conversation with them. That's how it really came about. It was like, what can we do that this is ironclad, that this is, we are in it for the long haul. What are the things that we can do to really demonstrate that, in the project? So, it was definitely something that was developed with our partner in terms of what it looks like. I mean, we have the 5-year transition. I mean, our financing, that's a little too complex to get into in this call. Maybe we can have an offline conversation about it. But the short answer is it was developed in concert with our financing partner, Amazon. And we are structured that way. It is tied to the land. If we go out of business for whatever reason, that 99-year covenant is tied to the land. It's not tied to the organization. That's the thing that you all need to know.
That's great.
Thank you.
We are bumping up onto our time. Unless there are any other pressing questions, I want to thank Kimberly. Thank you so much for coming today, for sharing the work of the Conservancy, for answering questions that many people have had, and for your offer to have offline conversations. We appreciate that.
Yes, I'm sorry, go ahead, Michelle.
No, go ahead, please.
No, I just I've been wanting to actually reach out to many of you, but again, last year was my first year and it was COVID, it was a lot happening. So, I really am sincere about the invitation to talk additionally with many of you. You've been on my radar. It's just, only so many hours of the day, but, excited about, we're in it for the long haul. We believe in partnerships. And so, let's have conversations where, there's where if and when it's possible, would love to discuss it. So thank you again for your time.
Yep. And I want to remind everyone that, again, this has been recorded. It will be online. Kimberly, I think this is the start of the conversation and not the last conversation. So we look forward at the appropriate time to having you back and continuing this discussion. As someone said, we need to be concerned about this continuum of housing need, and we all need to be in this together and do what we can to support that housing need throughout our region. It is about our region's competitiveness, our sustainability. So it's critically important to all of us. So thank you again. Thank you to JBG Smith for sponsoring this presentation. We appreciate that, Bailey. And I guess with that, we will conclude the presentation portion and we will move on to the NVAHA Leadership Council meeting.